Do you expect, Professor Prasad, that the tightening in U.S. monetary policy, or the withdrawal of the Fed, if you may want to call it that, will begin in the middle of next year? And will that mean, is the Fed behind the curve at all, or do you think that they waited long enough for a degree of robustness to come back to the U.S. economy before moving ahead?
It's a very difficult time for the Fed right now because many indicators, including what's happening in terms of employment, the unemployment rate, GDP growth, all suggest that they should not only be withdrawing their quantitative easing operations, but perhaps think about aggressive tightening. But on the other hand, if you start looking at the inflation numbers, there is absolutely no indication of tightness in the labor market translating into wage pressures or into inflationary pressures. And of course, the external environment looks very weak. Now, right now, the fact that there is talk about the U.S. tightening sometime next year, perhaps in the latter half of next year, has kept the dollar very strong, which is good for the rest of the world because the yen, the euro, and many other currencies have been depreciating against the U.S. dollar. But there is a limit to which the U.S. dollar can sustain appreciation against practically every other currency. The U.S. is not a very open economy, very dependent on trade. So a strong dollar through cheap imports and through keeping inflation down may actually give the U.S. some more room to string out its monetary policy. So the Fed is caught in this very difficult bind that the asset market pressures are probably there. There is some degree of fraudiness in asset markets, but those two have tamped down in the last few months. So I think the Fed is waiting to see some signs of a pickup in inflationary pressures, either in terms of long bond yields or in terms of inflationary expectations. And the funny thing is, it's not happening. So there is no good reason for the Fed to move. But I think if the labor market continues to deliver such strong performance, they will end up having to pull the trigger. And I'm sure once they start pulling the trigger, they will do so in fairly aggressive manner to make sure that inflation stays under control. But right now, even in the U.S., the talk is really about concerns about disinflation. There is inflation slowing down rather than picking up. So the Fed seems to be in no hurry to act. But I know that the Fed officials are very concerned about it, what you mentioned, about getting behind the curve. So any signs of a pickup in wage or inflationary pressures, I think we will see some actions coming.
Okay, I have a quick last question on central bank policy before we get to the India bit of the interview. And that is, how do you see the contrasting forces in terms of central bank policies that will play out next year? You may have the Fed pulling back. You'll have the ECB diving into probably the purchase of sovereign bonds in Europe. And everybody's trying to figure out how that one will work. Japan's monetary policy will continue on the easy path. China might continue, with the loose monetary policy, so to speak. How will all of this work? And what will it mean for emerging markets like India?
For an emerging market like India, the one thing that one can be certain of is there is going to be an enormous amount of volatility in currency and currency markets and in terms of capital flows. Now, you've correctly pointed out that the business cycle conditions and therefore the anticipated monetary conditions of the major central banks are going in very different directions, with the US at one end and virtually every other central bank moving towards the direction of easing. How they ease, what sort of assets they buy, of course, is going to be very dependent on which central bank you're talking about. But already we have a bank like the Bank of Japan doing things that would have seemed inconceivable almost a few years ago, for the BOJ to actually be stepping in, not only buying Japanese government bonds, but also stepping directly into asset markets, including equities. But that's, I think, symptomatic of how much the central bank is being relied upon to pull both financial markets and economic growth back on track. The European Central Bank, of course, is in a much more complicated political environment, but if deflationary pressures continue in Europe and the core Eurozone economies, especially Germany, France and Italy, continue to show negative growth or essentially zero growth, I don't see how the ECB can hold back much longer. So the notion that the ECB has managed to get a lot of traction through its words without having to employ many actions, I think is no longer going to be feasible. They're going to have to act very aggressively. The Chinese central bank will almost certainly continue with a set of targeted interventions, but I think they may also start moving towards a broader easing, perhaps by reducing the reserve requirement on banks, how much reserves they need to hold at the central bank. So this is all going to lead to a lot of volatility in currency markets, and that, I think, poses some concerns for an emerging market like India, because it could get caught in this whiplash of capital flows around the world.
All right. So that brings us to India, and I want to get your assessment of what you've seen in terms of action by the Modi government so far. Are you disappointed that maybe we haven't really seen, a full blueprint of what this government intends to do, and not really big reform measures? Are you pinning your hopes on the budget next year? What do you make of the fact that it's going to be a stretch to meet the fiscal deficit given the low tax collections, the delay in the disinvestment process? Where do we stand in the Indian economy right now?
I was certainly more hopeful that we would see a big package of reforms early on in the Modi government. I was hopeful we'd see much more aggressive action in terms of some reforms that are clearly needed to put India on a higher growth path for the long term. We haven't seen that, but I think there is some method to the temerity the more I think about it. Because what Mr. Modi seems to be trying to do is make it clear that he's going to get some basic building blocks that are necessary for the economy to work well. The first is macroeconomic stability. The Modi government has been reasonably supportive of the Reserve Bank of India in terms of controlling inflation. It's been fairly careful in terms of fiscal policy to make sure that we stay on track in terms of reducing the deficit and debt levels, although it's certainly becoming more of a challenge to maintain that path. So macroeconomic stability is essential before you can start talking about structural reforms taking root. In addition, what Mr. Modi seems to be focusing on is good governance, getting the government to work better, dealing with certain issues like corruption, and frankly issues like sanitation that might not seem to be on the front burner of the reform agenda, but are really important in a couple of dimensions. Number one, of course, they have very important implications for women's dignity and health more generally. But in addition, I think they are very important in terms of creating the narrative that any reforms a government undertakes are going to benefit the masses. In a country like India or China, I think it's a reasonable narrative sometimes that the benefits of economic reforms are largely going to go to the economic and political elite.
Is all of this, at least in the near term, especially because we are having a slightly more near-term conversation right now, going to help India sort of shield itself or deal with the volatility that you've anticipated next year? So I'm just trying to get a better sense of India's economics 6 months out. Are we in a better place to deal with any of this volatility? And since this is the last 30-40 seconds we have on the interview, I'd like a quick comment from you as well on what you make of the RBI's position on inflation and therefore its decision not to cut rates in its last monetary policy meeting.
It's very important for the Reserve Bank of India to focus on its core objective, which is fighting inflation. And I think it's much too early to declare success in the fight against inflation. So that is the biggest goal that the Reserve Bank of India has. And in terms of its ability to support growth, we need macroeconomic stability from there. I think what India has done in the last year or so has given us a lot more protection from external shocks. The current account balance is down. We have a larger level of reserves. The rupee, I think, is at a reasonable level, and there is some more room for movement around there. So I think we're reasonably protected from external shocks, but we need a lot more momentum in terms of getting the economy going and back on track to a high growth path.
All right. You're saying there's room for a further depreciation in the rupee?
I think a mild depreciation in the rupee right now will not hurt us very much if there was a pressure in terms of capital outflows, if the Fed were to tighten. I don't think that will add that much to inflationary pressures, and I think the economy can take it. Falling oil prices have certainly been a big boon in that context.
All right, Professor Prasad, we'll have to leave it there. Thank you so much for joining us.